Okay, so just to introduce the subject, so pricing XVA. Definitely a topical word these days, XVA. I don't know how long it's been around. It's been like 2 years maybe. I don't know when the first time XVA came up. On the panel, Christophe Drozo, CVA and FVA project manager from Natixis. Sebastian Lombard, global head of scarce resources at Société Générale. Okay. And Laurent Olivier at Veligny, at global head of valuation control at HSBC. And Augustine Biot at senior manager at Chappuis. People primarily from institutions that are doing this stuff. So it's definitely people who are dealing with this in practice, which is the right people to talk to. I think there's a slide up there. I'm not going to dwell on it too much, but just to start with, in terms of the audience, how many people are in institutions that currently price XVA, so CVA plus anything else, basically? I'm going to survey of hands. All right, some volunteered. Okay, so mixed. All right. So not too many people are willing to admit it, I guess. So there's a panel. So I think it's mentioned at the very beginning that where things are in the market at the moment is that CVA has been around for a long time. Every few months there's a new word comes up. I think the one I saw today was I think it was DVA, which is a different DVA from other DVAs you would have seen like a couple of years ago. It's a new DVA. So there's a slide up here sort of outlining what are the components of a trade. This is one way to slice it, but basically the message without going into it is that there's a lot of components, and the way you slice up the trade and how you look at it has an impact. So within a firm, there's an accounting impact, there's a regulatory impact, there's a business impact. Each of these has different demands on what you want to calculate. This particular slice here, you're looking at CVA, you're looking at DVA, KVAs are looking at the capital cost of the trade. MVA here, we're talking about the margining cost, the initial and variation margining cost. So lots of different dimensions, some of which are included in the trade itself, some of which are in the market. You trade a swap, you're going to get charged this if you're on the other side of the trade. Some of which are relevant in terms of profitability, many of which are still evolving today. So we have the right people to talk to us. So I was going to basically go through a bunch of questions, pose it to the panel. Feel free to ask questions. I think at the end we're going to have questions, but put your hand up if there's something that's not clear. It's a group where it's definitely the size that you can ask questions. So starting off with Laurent Olivier. So you're in valuation control, right? So you see prices, and it's sort of an interesting. I mean, I guess in some sense I've seen in this context before. I've seen in other firms talking to people from valuation control. It's interesting in the sense that you see things that not a lot of other people see, right? So you see one price. So you've got a swap. There's only one price.
There used to be only one price. Now there are many prices, even for one swap. Okay. So clearly we are not in the old time. There was one single price. It was easy to price test and to benchmark. Currently, when it comes to even vanilla transaction and when it comes to funding valuation adjustment, there is a diversity of practices, and obviously we are in the middle of a long journey. If you look at the financial statements, banks have disclosed a number of funding valuation adjustment up to $6 billion in a cumulative way. So it's a big amount, but they were quite cautious when disclosing their methodology. They recognize that it's a work in progress, that that the industry has not settled in terms of methodology and assumptions, that there are still some refinement going on, so and that there will be some evolution clearly. So it's definitely work in progress. So that would be my first comment. Now, when it comes to pricing, I would say that from a valuation controller, from an independent controller, we face a number of we have to cope with many prices. There is the front office price. It is important to differentiate between the front office pricing, where front office is happy to risk manage, happy to trade, happy to unwind. So that's one price. There is the price at which we book the transaction, and we need to be compliant with accounting rules. So clearly, what is it? Is it an exit price? Is it compatible with the IFRS 13, etc., etc. There is a third price that we need to tackle. It's the prudent valuation price. So there is obviously a difference between where, from the regulatory perspective and the accounting framework. So that's and we need to reconciliate and to understand the differences and to explain why we have these two numbers. And we have also two additional prices. We may have to compute a price in a specific exercise, which is called recovery and resolution. So if we had to unwind our exposure, what would be the true exit cost and not the cost of risk managing the position on an ongoing basis. So when it comes to funding fair value adjustment, which is today's topic, the question is which is the right spread to use. Is it our own funding spread? Is it the market funding spread? Is it a stressed market funding spread, etc., etc.? So that's not an easy question, and there is not one single answer. So definitely not an exact science, and definitely not one single answer.
Okay, great, thanks. So that actually, the comment about the right spread, the right rate, I mean, that sort of leads a little, into a related subject. So, Christophe, so CVA and FVA project manager, you're dealing with different parts of the business, so risk management, the desk, other parts of the business. So you see a perspective across parts of the firm that not everybody sees. So in any deal, there's two counterparties. Each of those counterparties is going to be maybe different capability, different philosophy about how they look at XVA. What do you see that? What are your thoughts about where that difference may come from? And we talked about the rate that you might apply to different components. Do you have any sort of?
Yeah, Laurent Olivier talked about several prices for one deal, but actually there's another kind of multiplicity. It's the different types of counterparties. You said that for one deal there are two counterparties, but actually we can differentiate at least two kinds of counterparties: the CIBs on one hand, and on the other hand the corporates. Both categories are subject to accounting rules. But actually, the corporates are quite passive to it. They have to account for derivative, but they can't really price. They are not mature enough to challenge the incorporation of any valuation adjustment that a CIB would charge to them. And on the other hand, the CIBs, depending on the degree of maturity they have reached, will incorporate in the price, in the different prices, different kind of XVAs. A few years ago, the discrepancies between the different prices a corporate could get from different CIBs was mainly based on the management of the funding of the collateral, and nowadays it's more based on the cost of capital. So what we could say in a few words is that we have different prices, we have different counterparts, but at the end of the day, we make one deal at one price, which is still the balance reached between the two counterparties when they agree to make the deal.
Okay, thanks. So, two counterparties, different capabilities, different, things that they're, different ways of looking at, the trade. So Sebastian, so you're global head of scarce resources now. So that's, to be honest, that's a title I don't think I've heard. I think I've heard that title for about a year, not beyond that, right? So it's quite an interesting title. So I guess for scarce resources for a bank now has got to be capital, I suppose, at the moment, right? So is the different institutions trading, different capabilities, whether the counterparty is a bank, a corporate. What do you do? So do you want to, will your advice be, okay, you want to be ahead of the curve, you want to be a leader in taking these charges on and looking at being able to price XVA and incorporate it, or do you want to be a lagger and sort of wait until you see how the market evolves? What would your advice be in that respect?
I would say definitely we want to price at the beginning any futures cost linked to XVA. If you take, for example, the OES discounting, if you are the last one pricing or taking into account this pricing, at the end it would be a loss, and it could be a huge loss. So, it's better for the firm to start pricing correctly any future impact. Even if maybe you lose part of the business or you lose some clients because some dealers are still using aggressive prices because they do not take into account all the impact. But you don't want to have, like it was the case for CVA or for AVA, you don't want to have losses in your book. And losses you will take, and you will take it in the coming years. So you want to price anything, any constraint. You're living in a moving world, and if you are not the first one pricing or taking pricing correctly, it will be a huge loss at the end. So yeah, you want to price anything, any constraints or any future costs you need to pricing. It could be leverage ratio, funding, CVA, etc.
Okay, thanks. So, so you don't want to be the last. Augustine, you're a senior manager at Chappuis. So, in terms of actually day-to-day, in terms of practically implementing XVA, in terms of what are the things you need to consider, what would be your thoughts or advice to anybody who's looking to start calculating XVA?
First, I would say that there would be 3 dimensions. The strategic dimension, the organizational, and this is going to be the object of panel number 3, and methodological impacts. As a strategic impact, I think it's important to know where you want to go. It's a trade-off between the cost of implementing pricing solution for XVA. It's also a cost for resources, having good people, good traders, good product controllers, good collateral management behind everything. It's also a trade-off between the cost of pricing, the time consumed into pricing, but it's also an organizational shaker. that's the next panel. But you have different methodologies to price different VAs. Some of them are overlapping. So my advice would be maybe pick the most the VA that is the most impacting your organization. Quickly try to assess the numerical impact, but also the cultural and organizational impact. Are people ready within your organization to incorporate VAs? Are people able to correctly risk manage and account and disclose into the regulatory ratios any impact coming from all the XVAs? That's the key message, I think.
Okay. Okay. So yeah, I mean, you often hear this trade-off between being absolutely correct and being able to actually calculate it. So that's always a component. So in terms of coming back to a couple of subjects that are in the press at the moment. One of the things that I would have argued is there's a convergence between CVA and FVA. I mean, it was commented about the number of banks that have included FVA in their balance sheet. There's been surveys around how many banks include CVA in their pricing. So I think it was about 85%. I think of a certain survey of banks that include CVA and FVA in all of their deal pricing. Is that convergence something that we see? So Laurent or Olivier, I would ask you, given that you see prices from different sources?
There is a convergence in terms of principle, for sure, but there is still a wide range of dispersion when it comes to practical implementation and detailed assumptions, clearly. This is something that we can observe on consensus pricing. When JP Morgan disclosed for the first time their funding fair value adjustment 1 year or 18 months ago, so it was a $1.5 billion hit as far as I can remember. So they did it, but just after having asked the industry to participate to a consensus service, just to demonstrate that funding fair value adjustment was real. And what we've observed so far is that there is a wide range of pricing, and it's not surprising. People do not have the same model when it comes to cash flow projection, EE calculations. Of course, people do not have the same spread, funding spread. Some firms have introduced some behaviorization in terms of prepayment or redemption, etc., etc. So we still observe a wide range of prices for a given trade in the market.
Okay, well, that's interesting. So still variation. So a trend to some convergence, but still lots of dispersion around the mean, so to speak.
And there are still some banks who claim that funding valuation adjustment should not be an accounting item.
Yep. Okay. Yeah, that's something that was interesting. I think there was a comment about some of the. I think there's a question even about some of the recent articles about that question. Where does is FVA going to fall into the accounting side, the regulatory side? Where it's ultimately going to fall out. It's definitely interesting. So I guess Christophe, you might be a good person to talk on this subject. In the theme of yet another XVA, KVA, capital valuation adjustment, I think it's one of the few where I haven't seen many alternate words for the same thing. So I've only ever seen KVA, which is good. But that's the idea of trying to capture the cost of the regulatory charge. So you talked before about kind of what's the right rate. I mean, I think that's one area. There's been comments around. There's the largest discrepancy about what rate you might use to discount that. So from an accounting perspective, you might use sort of cost of capital, if you wanted to be consistent with FVA, you might use kind of a, a lending or a borrowing spread. So very, very different rates. So any thoughts on that or anything? You can throw it open to the panel. I also put you on the spot here.
What I will say is that the KVA is one of the most complex VA to model first, because it comes to regulation. And the first hypothesis to make is that the regulation won't change in the future when we make a deal, because it would change the charge, actually.
Sure, yeah.
And then, well, the different aspects of the capital pricing, or the market risk, operational risk, counterparty risk, etc. It's quite hard to incorporate in the computation. It's really computer demanding, really hard to model. And then you have to choose a rate to discount it on the life of the trade, and you have to make the whole picture, the whole XVA picture, coherent, which is not an easy question. There are still debates on the coherence between the FVAs, CVA, DVA. So KVA is another aspect. Another remark is that we don't have any real accounting practice on the FVA in terms of norms for the moment, but we have a prudent valuation adjustment if ever we incorporate any FVA in the P&L. For the moment, the KVA is outside of the picture in terms of regulation, but I guess it will come quickly in the picture. But still, having said that, it's today the biggest observed discrepancy in the prices. But as Sebastian said, the sooner you price all the charges and the constraint, the smallest you make the loss when you take into the P&L. But still, the other question is how do we price all the VA? And the question, I think, is still open.
Okay.
Yeah, for me, the capital is priced since the beginning. Since I began in the industry, we price a minimum return on equity, which is KVA. The question is more on the accounting part. I'm not sure we want or not to take into account in the accounting, but it's price limited. It was the first VA priced in the market. Maybe more for loans than on derivatives, but it's priced in many years.
Okay.
What I can see is that there is a momentum here. 2 years ago at a conference in London, the yearly valuation conference, there was just one question over the 2 days. 1 year ago there was one single presentation, and recently there has been some more and more talks about that, more articles in Risk Magazine and other articles. So far, the accountants and the auditors have been voiceless, so I haven't seen any debate raised by auditors on that subject. And when it comes to the regulatory framework, surprisingly, the prudent valuation framework did mention that when I look at the first RTS, they mention the cost of capital when it comes to prudently marking and this sentence has disappeared in the final version. So that's interesting.
Okay, no, very.
So I guess it's long term.
Okay. No, it is interesting. I mean, the comment about the capital cost being kind of embedded in the business for a long time. Yeah, I think how it's managed, it's, different institutions do it differently, but it's an interesting. It's definitely an interesting area. I think it is interesting. I mean, it's a great time for quants in some respects. Good time for regulators. So lots of work. But I think one of the things that's interesting about this problem domain is that it takes most people into very foreign territories. So for a quant to start understanding how the capital charge is applied to a business is like totally foreign kind of concept. So I guess a final thought. It's an interesting, again, also topical discussion around FVA. So I think you'd said, I mean, JP posted a 1.5 roughly $1 billion loss. I think the total is, what is it, 6 or something, 6+ billion. That's a lot of money, I think, for me. There's a paper in 2013, and there's some discussion around it. It's by Albanese, Anderson, and Ibachina, I'm not sure I'm going to pronounce that correctly. But they had a couple of things. One around where FDA is their version of FEA, basically, slight variation, should come out of bank equity. That's a bit of a controversial discussion. But one that seems to be getting a broader discussion is around calculating FVA across the whole firm, not on a netting set. Yeah, maybe I'll kind of throw this open to the panel. I mean, I guess there's one thing is, do people think it makes sense? And the second thing is what, to me, even the more interesting thing is what would be the impact of suddenly the banks turning around and saying, oh yeah, whoops, we made a mistake. It's actually not 6 billion, it's only 2 billion or something. It's a pretty I don't know, it's a pretty shocking thought, right?
It just makes me think of about 2 or 3 years ago when IFRS 13 came up and we had to comply. Actually, we were pricing CVA for 10 or 20 years into French accounting norms, but we didn't use market spreads, but historical probabilities. Oops, it was an error. Oops, it costed millions.
Yeah.
So I think this kind of error, if it could be in the right way this time, would be a
could be good news. Buy bank stock,
but
right?
I'm not sure.
A huge profit.
I'm not sure.
All right. So I guess throw it up. How time is going? We're good. We're good. We're on time. Okay, that's good. So open up questions. So I know there's some co-workers of the panel here. So there should be lots of. This is your chance to ask tough questions. So. Any starters here? I'll have to think of a question. I didn't have a question myself. I've got my question. So I guess maybe I'll follow on from one of the earlier subjects, right? So in terms of I think Sebastian, you talked about different institutions having different capacities, two sides of the trade. From a client perspective, what do you think is what do you think is needed? I mean, in a sense of, I imagine if you're a buy-side firm, you have no capacity to price this stuff in. What are you going to be able to do to convince them? Or do they just accept it and saying, I'm really not happy, but I don't know how to. What do you think is the solution there? Is education a solution, or?
I mean, FVA is quite easy to explain to a client. It's a funding for him. It's something he can easily understand. When we go maybe on more exotic XVA, like pricing of leverage exposure, or pricing or LCR and SFR, which is a cost for the firm and not a win for the client, it's quite tricky to explain. But the AVA, I mean, I think that all the clients understand the pricing and understand the impact for them and for us. I don't know.
Okay, thanks. Any other thoughts? Any from the rest of the panel on that subject? No? Okay, so maybe any.
do you see any players in the market trying to cut prices? I mean, really to be competitive on pricing and taking more risks in this unstable period of time?
You always see discrepancies between the way the firms are pricing the different products. It could depend on the internal rules, on the, let's say, if the traders are sophisticated or not. I'm not sure it is fully a choice of the bank to be aggressive, competitive, or to maybe to misprice sometime.
I would like just to stress that CVAs and FVAs, these are the most exotic products that we are running in the firm, most complicated to price. So it's not surprising that we observe this discrepancy in terms of prices. In addition to that, the price that we offer to a client depends on the exposure that we have. So there are some netting effects. So here again, we will observe some differences in terms of pricing. So I would concur with your view.
And just one other question is, do you see any businesses that you need to close or shut down because of these XVAs? Reduce.
I mean, you need to price. You need to price correctly, and at the end, if you are the only one, the activity will die. It's not. I mean, if everybody price and use the correct price, there just will be a repricing, a global repricing of the activity, and the activity will survive.
Any other questions? So I might wrap up with a sort of final one through the panel about what's their crystal ball view of 2 years' time, say, not too far away. Financial markets in 2 years. What's the state of the world? Is there maybe I'm going to start. It's not an easy question. So in this subject, for example, is in 2 years' time, are there still, there's still discrepancy, or everybody's solidified, or does something new come up, or where do you see the markets in 2 years' time from?
I mean, there will always be discrepancies. For example, on the FVA, as it really depends on your cost of funding. You will find some discrepancies between the dealers, but you can explain the discrepancies. For the pricing of the capital, it will depend on the usage, on how it is a constraint for you. So it's just a new world where you have to price everything, and you can explain some discrepancies between the prices of different banks, and you have to live with it.
As for me, I would say that the trend is that we will observe an increase of complexity. So this is what we've observed, and this is what we will still be observing. One example is striking. It's the OIS discounting. So we have switched from LIBOR discounting to OIS discounting, using the currency of a trade, then using the currency of a CSA, and then introducing the cheapest to deliver. And then so this optionality, is it deterministic or stochastic approach, etc. So we are still in a process of refining the calculations. That's where the industry is. So my perception is that we will see greater complexity.
2 years' time is quite short, I think, but perhaps there will be a shift from counterparty risk to liquidity risk with the introduction of a more initial margin more clearing on one hand, more initial margin where we don't clear. So we need more to finance and to find more liquidity.
As for me, I would see more convergence between organization towards a regulatory framework. We see that regulators are thinking about FVA. Why not MVA in the coming years? Why not another VA? That's for one. Two, I agree on the complexity. So this convergence will be towards a more complex world, probably. And probably we can look back in 5 years. that would be probably best to give all organizations time, enough time to adapt.
That's very. I mean, these are very good comments, I think. So it's interesting, the comment about, okay, there's divergence, but we still should do it, and maybe the divergence is not something to worry about. Like say, complex pricing, there's differences. Increased complexity. Yeah, I mean, it's pricing a swap 10 years ago seems like a wonderfully simple world relative to today. Yeah, I guess that's the way things, that's the way the world is. I see on the quantitative side, I do see a what's the right word? There's thoughts and there's iteration, and I think there will be a bumpy convergence into accepted best practice, the same way that you might, for a complex derivative, generally, convergence into the right way to do it. There might be variation and different ways to calibrate, but there'll be an accepted best, practice. So from what I see on the quantitative side, a convergence in terms of approach, but probably, like you say, there'll probably be differences in results as there is in the marketplace. The liquidity, I think, is a very, very important and very good topic. I think it's always worth remembering that credit risk, I can't ever remember credit risk killing a bank. So liquidity risk is generally what does them in. So the liquidity risk when clearing initial marginal loss comes through is going to be extremely important. All right, so thank you very much to the panel. The same subject. So I hope that was interesting for everybody, and I'll hand off to the next panel. Thank you again.